So tell us, something is happening in markets this year that's only happened 2 other times in the past 15 years.
Oh, rare item factoid. All right, bring it on. I love those.
The S&P 500 is underperforming international stocks, and by a really big margin. It's underperforming international stocks by 16 percentage points. That's the widest margin since the early 1990s.
Well, I kind of knew that was happening. I didn't know it was quite to that degree.
It's crazy.
Yeah, and we're going to talk with our guest this week about why investors have increasingly been looking abroad. Hey, everyone. This is Telis Demos, and this is WSJ's Take on the Week, the weekly show where we give you a leg up on the worlds of money and investing.
And I'm Gunjan Banerji.
This week, we're going to be talking about investors move abroad, why people are buying stocks outside of the U.S. more than they have in recent years, or maybe why they should be.
But before that, Telis, I'm curious. Is the trade war over?
I don't think it is. I'm sorry to say for those who were hoping for peace in our times. Put it this way. It wasn't like a huge directional move. Oh my gosh, the trade war is now over. And I think that's because, look, obviously there was a ruling from the U.S. Court of International Trade, which nobody knew about until this ruling.
Not a lot of people were paying attention to it.
Unless you're like a trade lawyer or something. They ruled that Trump didn't have the authority to impose some of the major parts of his tariff policies, like the fentanyl-related tariffs on China, Canada, and Mexico, the 10% kind of global baseline, the reciprocals, because he used something called the International Emergency Economic Powers Act, or IEEPA, of 1977, to issue those tariffs. And the court said that he couldn't really do those things, that act didn't support that authority. However, there are other trade authorities that a president has. You have section national security grounds for a tariff. That's section 232 of 1962. You have fighting unfair practices from other countries. That's section 303 of a 1974 law. And Trump has used those other things before. The first term China tariffs were, I think, mostly using those other authorities. So the president has other avenues, and of course he will be appealing this international court ruling.
Sure, this could end up in the Supreme Court. It complicates everything.
It really throws things into a whole new kind of realm of uncertainty. We already had the uncertainty of just like, what does the president want to do? And now we have the additional uncertainty of, okay, well, what will the courts say about this going forward?
So the S&P 500 roughly flat for the year. Stocks have recouped their losses since that big drawdown in April. That meant that traders were betting that Trump was going to kind of back down on tariffs, and this was a negotiation position, that we were not going to see the really steep tariffs that we saw in early April.
And I still think that the market probably will go forward with an assumption that there will be some degree of tariffs. I mean, there are a number of tariffs in this current round. For example, the product level tariffs like steel, autos, that are not subject to this ruling. So there are still tariffs happening, probably at a level beyond what the market thought was going to happen just a few months ago. So I don't think that we can just say, oh, okay, well, maybe none of this will be happening. I still think that the market has to go forward on the assumption that there's some kind of tariff that's going to be higher than what people thought a year ago, and to put that into all their forecasts about company earnings and things like that.
That is such a good point. The big takeaway for me, though, is that it is really, really hard to trade around Trump's tariffs. I'm thinking about, just a few weeks ago, I wrote about how there was record selling among hedge funds around Liberation Day. That has not paid off, right? Everyone thought the world was ending and stocks have just rebounded. And we've kind of made this really big U-turn. So even though it's been such a trying year for the buy and hold trade, that's kind of what's paid off recently.
So how should people be trading this? What is the right answer when there's really like pivotal, enormous uncertainty around like certain things, right? Whether tariffs are 20% or 10% or whatever is hugely important and also unknown. So how on earth do you trade or invest around that?
It feels like the big takeaway based on the recent market action is don't. It's just really, really tough. And to your point about just the intense economic uncertainty out there, I think that's why everyone's going to be watching the jobs report in coming sessions, right? For a look at how the economy is holding up at a time when everyone seems to be forecasting a recession.
Yeah, though, I got to be honest, I don't know what a good or bad jobs report really ultimately means for us. Because if you have a bad jobs report, right, I guess typically the thinking is, oh, okay, that means the economy is weakening, which means the Fed will, cut rates, right? But if tariffs are still happening, then the Fed is, of course, worried about the inflationary impact of tariffs, and it might not want to cut rates.
Sure.
That means that, okay, no tariffs is good for the economy, but it's maybe bad for the deficit, right? On the other hand, you've got, okay, well, if there are still going to be tariffs, well, that offsets some of the deficit, but then it's going to slow the economy. So within all of that, it's hard for me to feel like I even know what a good or a bad jobs report will mean. Do you feel like you have some clarity on that?
Well, we certainly want to see that the U.S. kept adding jobs, right? And the fears of a recession are hopefully unfounded.
I mean, just from a human point of view, yes, I would like to see that more people are employed. Yes.
Yeah, but I think you're right. I think we could see a ton more volatility in the bond market. 30-year Treasury yields have been, rising above 5%. Now more than ever, it feels like there's just so much uncertainty out there about deficits, the U.S. economy, tariffs. And that's why I was so excited about this conversation with David Kelly, who is the chief global strategist at JPMorgan Asset Management.
Yeah, we talked to him before the tariff news, but I think it's interesting to note that a lot of what he talked about in the big picture for investing in the U.S. versus globally doesn't even have to do with tariffs. So there's a lot else that goes into that conversation.
That was really interesting. That's after the break.
David, what does it mean that you are a global strategist? Does that mean that you talk to U.S. investors about where to invest around the world? Do you talk to outside U.S. investors about how to invest in the U.S.? Like, what does that actually mean that you do all day?
Well, both of those things, but mostly it means I get to run a global team of strategists around the world. We actually have a meeting at 9 a.m. every Monday morning just to talk about how economies and financial markets are moving around the world and what insights we can find about those. And of course, a lot of what's been going around the world the last few months has been really dictated by policies emanating out of Washington. So I've been pretty busy speaking to obviously investors here in the United States, but also around the world about what all this means.
It seems like in the biggest way in some time, investors are really starting to question this American exceptionalism trade. I was looking at some data, and U.S. stocks have underperformed those around the world by 16 percentage points this year. That's on track for the biggest annual underperformance since the early 1990s. So we haven't seen an underperformance like this in quite some time.
Well, that's right. And I would say that there are at least two flavors of U.S. exceptionalism that show up in financial markets right now. One of them is U.S. equities, where the price-earnings ratio on U.S. equities overall, the S&P 500, is 50% higher than for stocks outside the United States. And that there's always been that premium for U.S. equities, but it has never really, until the last year or so, been as high as that 50% premium. And that does speak to an exceptionalism, which has probably gone too far. And then the other part is the U.S. dollar. The U.S. dollar has really been going up off and on since 2008. So for more than almost 20 years now, the U.S. dollar has been going up. And again, we run a huge trade deficit. We run huge big budget deficits. As the dollar has gone up, every time the dollar goes up 10%, the value of your international stocks goes down 10%. So for U.S. investor, they've seen U.S. stocks outperform year after year after year. And that's why I think this year is such a shock to people, because maybe the dollar shouldn't be as high as it is. And if the dollar starts going the other way, it's going to amplify the return on international investments. That's one of the things we've seen this year.
So do you think this underperformance will continue?
I do think so in the long run. First of all, on the dollar, it has come down about 8% year to date, but it still has got a long, long way to go. And an overpriced dollar is part of the answer to why we've got a big trade deficit. The other reason is a big budget deficit. Those two things have really contributed to this trade deficit. I think the administration has sort of recognized that from time to time. I think we complain about other countries manipulating their currencies down, but you know what? We've been manipulating our currency up, or we've been allowing it to be too high. I think generally people on both sides of the aisle in Washington are realizing that this dollar has been unhealthily high for too long. I think it could come down quite a lot, particularly, by the way, if investors sort of reverse themselves on U.S. exceptionalism, because U.S. investors have been piling into U.S. stocks, but global investors have been piling into U.S. stocks. If it moves a bit the other way, that reduces the demand for dollars and pushes the dollar down also. So I think you could see that happening. And then obviously if the economy is going to grow more slowly over time, I think that does take a bite out of US earnings. Again, people may diversify their portfolios and buy international stocks, which again could reduce that premium a bit. So it's not like the rest of the world is going to do really well and the US is going to do really badly. But if they're moving at roughly the same pace, then I think there's a lot of ground to be made up by international stocks and by non-US currencies.
Do tariffs play a role in your view that US stocks will underperform in coming months or years?
Yes, they do. I mean, tariffs are, I'm an economist and I don't really believe in tariffs as a way of solving a trade deficit problem or in fact anything else. But tariffs and tariff uncertainty is certainly having an impact. I think the uncertainty, particularly since April 2nd, has been amplifying the problem. And I think if that uncertainty diminishes, if over the next few months we do come up with some trade agreements and we end up with, say, a universal tariff of 10% on everybody outside of Mexico and Canada, maybe something less on Mexico and Canada, maybe something more in China. But if the policy becomes clear, that on its own could reduce concerns about the United States. But the tariffs and the sort of on again, off again nature of the tariffs and make the difficulty in making investment decisions with regard to the United States, I think all of that is playing a role in helping international stocks outperform so far this year.
But let's say that we did get some clarity and tariffs were fixed at some level that's maybe higher than a lot of people would like, but at least we know what they are, right? Like let's say there's this 10% baseline or maybe higher for some countries. What does that do to international flows of capital into the U.S.? Because you could see, some companies might want to start producing more inside the U.S., right? So that drives foreign domestic investment into the U.S., and if it drove U.S. growth, right, because we were reinvesting in our domestic industries, could that also continue to make the U.S. like a relatively faster growing economy? I'm just wondering, are tariffs strictly a reason for U.S. exceptionalism to end, or is it more a view on how you think those will impact the economy?
I mean, the tariffs don't help. And, with regard to reshoring manufacturing, it takes a long time to build up manufacturing infrastructure and all the things that you need in order to manufacture here. And even if you did all of those things, I'm not even clear that the manufacturing jobs you'd end up with are that great as jobs. That's part of the story. But I think the other part of the story is we've just seen a very long run of U.S. outperformance leading to this valuation gap. And if nothing changed, the valuation gap is hard to justify because with the U.S. growing more slowly and with potential for Europe perhaps to grow more quickly after years in the doldrums, and of course with plenty of growth potential in emerging markets, it just makes sense to rebalance a bit. And so I think that's it's not just about the tariff story; it's just people recognizing that U.S. assets are pretty expensive relative to the rest of the world, and they personally are way overweight U.S. assets, and they need to adjust to both of those things.
So even though we don't have perfect clarity on the tariffs right now, investors are kind of acting as if we do, right? I mean, take a look at the S&P 500. It's recouped all of its losses since Liberation Day. It's now flat for the year.
But that hasn't fixed the underperformance versus the rest of the world.
It hasn't, but people are not as gloomy as they were just, a month and a half ago.
But maybe that's maybe because the rebalancing is still happening to some extent, despite that, is an indication that we are in a, call it secular change, I guess, in the way people invest. And there will be diversification going forward just because the whole tariffs episode happened, regardless of where they land. That just raises questions in people's minds about the sustainability of U.S. exceptionalism.
Well, David, what do you think of the rally since early April?
I mean, there's a T-shirt you can buy in Britain which is sort of say, says "Stay calm and carry on." But honestly, I think when it comes to investing, that's really what American investors are. I mean, American investors are better able to ignore whatever's happening in Washington and just focus on, let's put money to work. They've got money to put to work. They want to put it to work, and they buy the dip. And maybe it doesn't make complete sense in terms of a rational valuation of markets, but while consumers appear to be gloomy, and maybe investors are gloomy too, they do tend to put money back to work in markets, and it pushes prices up. I mean, if you're running a big mutual fund and money flows in the door, you got to put it to work. And maybe the people who are putting money in your fund are nervous, but they've got no other plan other than to invest in the stock market. So that is creating inflows. So I think what's going on is it's something of a relief rally as the uncertainty around tariffs diminishes a little bit, money just comes flowing back in, as it always does when you have or it has done for many, many years, when you've had one of these shocks which cause greater uncertainty. The uncertainty diminishes and the market just bounces back. That's what I think has been going on.
Buy the dip has become like a viral stock market sensation among individuals, right, Telis?
Well, I was going to say, I mean, Gunjan, you know as well as anybody that the U.S. retail investor is basically a perma bull, right? They
Not
never
all of
seem
them,
to.
but they like to buy during times of market stress, and we saw that this year.
Okay, so that brings me back to feeling like we shouldn't abandon American exceptionalism once again, because unlike other markets around the world, right, like in Europe, correct me if I'm wrong, but in Europe does not have the same retail stock investing culture that we do here in the U.S. I don't know if people's 401ks are sort of, or whatever the equivalent is in Europe, are always sort of set to auto buy. And so is that a reason itself for U.S. exceptionalism? Is just the way that we invest here in the U.S. and how we just believe in the stock market, like David said, stiff upper lip, keep calm and carry on. We've got a British attitude about stocks here in the U.S. Is that a reason to kind of bet on American exceptionalism?
Well, I still wouldn't put a big bet on American exceptionalism. I think people have implicitly, passively got a big bet on American exceptionalism in their portfolios today. But yeah, I mean, I think the U.S. has always benefited from the fact that we are the most active, aggressive stock market investors in the world. The U.S. represents about 20% of the global economy in terms of GDP, about 5% of the global population. But the U.S. economy or the U.S. stock market represents 65% of global stock market capitalization, which means, not only is most of the global stock market located in the United States, but most of the global stock market investors are located in the United States.
I was chatting with an individual investor in Singapore. He's been in Singapore his entire life, yet 99% of his investments are in U.S. stocks. So I have to ask, this mentality of U.S. stocks are going to keep outperforming is so dominant around the world that what makes you think that this time is different?
Well, we'll see how long it goes. I think one of the things that happens in markets is people tend to extrapolate recent performance. So if you have 2 good years in which, or we've had many years, really since 2008, where the U.S. has been outperforming, people they don't try and rationalize it. They just put money in the U.S. and say, look, this has always worked. And so for that mentality to change, all you need is a few years in which the U.S. lags behind. There have been periods in the past where people thought Japan was the wonder of the world, or people thought Germany was the next coming. And in recent decades, people thought the U.S. is at the top of the world. But that has not always been the case. And for a long-term investor, it's really important to just be balanced, just spread your bets. And so I think what will happen is if the dollar falls for a few years and international stocks do reasonably well, then you're going to have a number of years in which the international stocks in your portfolio will outperform the rest. And then you're going to be asking your financial advisor, well, why did you only have 10% of my money in non-US stocks? And that's the conversation that starts this sort of long move back towards international outperformance, which could last for a number of years here.
And your advisor will probably say, because you told me not to. That's why.
Well, they'll change their tune.
How much of what we're talking about when we talk about U.S. exceptionalism, when we talk about the performance and the overvaluation of the U.S. stock market is about technology and the Magnificent Seven, kind of AI, big global tech companies? I mean, isn't that really itself the story of the exceptionalism of the American market? And now we know that those stocks are underperforming the market this year for the most part. But, if you believe in these mega themes, right, AI will transform work and business, et cetera, why would you invest elsewhere? Wouldn't you just stick with those companies and therefore stick with the U.S. market?
Well, first of all, that is part of the story. But what we've looked at is we've looked at the valuation of each individual sector looking at S&P sector groups across the US and non-US markets. And what we see is that in each sector, whether it's consumer discretionary or healthcare or technology, the US stocks get a premium in valuation regardless of sector. So part of it is, yes, more of the US stock market is in tech. That certainly is a positive because A, the tech sector has been doing really well from an operational perspective, and B, it has higher PE ratios. But even if you account for that, there has been a premium just because it said made in the USA. And I think that much is under some threat. With regard to AI, though, I mean, we shouldn't downplay this. It does have tremendous potential. And I think we're looking at an extended period of time where we're going to be short of labor, short of skilled labor around the developed world. And I think that only adds a further urgency to investment in AI. And the US still has a leadership position in many aspects of AI. So if we can maintain that, I think that does bode well for US equities long term, even if I think people ought to be a little bit more broadly balanced.
I was looking at some of the performance of major indexes around the world, and it's pretty crazy. I mean, major indexes in Spain, Germany, as of late May, were up more than 20% for the year. The S&P 500 is roughly flat. Where are you looking internationally right now, David?
Well, that is one of the areas. So I think European stocks have been particularly cheap going into this year. I think the euro has been particularly undervalued. And so what we've seen is a significant rally in the euro. And part of the total return you're seeing as a US investor is that dollar translation effect of the overall dollar is down about 8% year to date. And that's contributing to that outperformance. I'm looking at Europe. I think there's and emerging markets in general, I think are worth a look. China is, obviously the next big question. I think there's still lots of issues with China. I think they've got lots of longer term economic issues they've got to work through. Japan is, I think we've seen a lot of reform. I think they recognize the need to encourage private equity market investors. And I think that's a positive. I'd want to have some money invested there. But I think there's also big issues as they've been trying to stoke inflation for so long. I think they finally succeeded, and it's a little bit like the dog chasing after the truck. What happens when he catches it? So they've got some issues with inflation and interest rates. But other countries, things like Australia, Canada. I think Latin America in general is less impacted by tariffs in other regions. So there are plenty of other areas around the world where you can put a little money as sort of a broad investment in global capitalism and not just here in the United States.
Is there a way to effectively be diversified for the rest of the world? Like, what should you think of as the sort of non-U.S. equivalent of the S&P 500? Or is that just not the way it works? Do you have to start to think about, okay, do I want the FTSE in the UK and the DAX in Germany and the Nikkei in Japan? Or is there an all-world index that you think is the way to be a responsible, passive, non-U.S. investor?
Okay, well, just a little bit of investing jargon here. When we talk about global, we usually include the US and the whole world. So it's like an all-world index. If you talk about an international fund, it simply means it can invest everywhere outside the United States for the most part. So generally speaking, just look for international funds. And obviously, read up, make sure you understand what that fund's doing. But it is quite easy both to actively and passively invest in international equities.
Well, David, should people be thinking about owning, bunds and, Japanese bonds and things like that? Like, is that part of that diversification, or is that a whole separate conversation?
It's not quite so compelling because the problem is that with developed country bonds, you tend to have very low interest rates. So the yield on bunds and on JGBs or Japanese government bonds, those are both lower than they are in the US bond market. But what I'd say is that if you buy overall US long-term interest rates, I think are at reasonable levels. And one of the nice things about the bond market is if you buy say what's called the Bloomberg Aggregate Index, and it's yielding about 5%. Well, oddly enough, it turns out that your expected return over the next 5 years is it's probably going to be about 5%. It's very close. So I don't think there's nothing unreasonable about 5%. I mean, people are so used to getting 10% or 12% of their money, they don't realize that that's one of the weird things about recent decades is you've had these huge returns on financial assets in general, which probably aren't sustainable in the long run and are not justifiable in the long run. So if the inflation rate is going to be 2 or 3%, you make 5% in bonds, that's fine. That's good. Have that in a portfolio. But the other thing that we're seeing a lot of interest in is alternative investments. People want to be invested in infrastructure or real estate or transportation or something that's away from just stock bonds. Because people remember in 2022, when the stock market went down, the bond market went down too. And so I think what I'd say is I wouldn't look for lots of exotic ways of investing in the bond market, but I would look at, are there ways I can invest in alternative investments, things like real estate or infrastructure, or maybe even private equity here in the United States, in a way that diversifies myself away from both stocks and bonds here.
People always say that if America sneezes, the whole world will catch a cold. What do you think of that notion?
It depends on the virus. Back in 2018, the US imposed tariffs, but it was really a trade war with China. And in a one-on-one battle, then it looked like the US was going to win, and the dollar reflected that. The dollar went up, the US equity market went up. This year, we've sort of picked a fight with every kid in the playground at the same time. And the playground's betting we're going to lose. Now, hopefully, we'll see some moderation policies. I think we're already seeing that. But over time, that's not clear at all. I think the rest of the world is in some ways trying to be less vulnerable to the United States. And I think it's proving to be that way in markets so far this year. I think that will be it's going to be really important for the economic policy of almost every other country in the world to make sure they're not too reliant on the United States. And I think that's so going forward. Yes, there's some damage. If the US has a problem or causes a problem, then the rest of the world is impacted. But everybody is trying to build up the resistance and the resilience against that.
We're going to take one quick break. And when we come back, we'll have one last question for David Kelly. If you had to pick one country or region that you are the most bullish on across the world, what would it be?
Well, maybe it's because I've visited there recently, but I might say Australia, actually.
Oh.
Australia is far enough away from global trade wars. It's really not being affected that much. And it's, I think the economy there is moving forward pretty steadily. I think they've got a lot of advantages. I do like what's going on in parts of Europe right now. But for an investor, the thing is, you don't have to make these choices. You can invest in the forest. You don't have to pick the tree. And I think it's, we spend so much time trying to find the next winner that we miss the basic point of, well, I might spread out enough in the first place. And so I think a lot of people are very concentrated in large cap US equities. That's really been a mistake that's been revealed so far this year. It certainly hurt people this year. But that's really what they should focus on. They don't need to focus on picking the winners. They need to focus on their own biases. And am I way too concentrated in one area? I think that's how I'd approach investing in the long run.
David, this has been great. Thank you so much.
Anytime. I remember the original Magnificent Seven movie. I don't know if you ever saw it with Yul Brynner in 1960. But only 3 of them were alive at the end of the movie.
Yes, we talk about that a lot around here. Yeah, as time goes by, fewer and fewer people have seen that movie and know that fact. And
have you seen the movie?
I have, yeah.
So it's pretty good.
We'll have a viewing party.